Have you ever looked at the US national debt number and thought, how is this even possible? We're talking trillions of dollars, a figure so huge it's hard to wrap your head around. How does the country not just collapse under that weight? Well, the answer is kind of like a superpower the US has, and it's all about the US dollar. See, the dollar isn't just America's money, it's the world's money. It's the primary reserve currency for global trade. Whether it's oil from the Middle East or electronics from Asia, most major international transactions are priced and settled in dollars. This creates a massive constant demand for US currency from countries all over the globe. So when the US government needs to borrow money, it issues Treasury bonds. And who's lining up to buy them? Everyone. Foreign governments, international banks, and investors all need a safe place to park their dollar reserves. US Treasury bonds are considered one of the safest investments in the world, so they're always in high demand. This global appetite for US debt allows the government to borrow at very low interest rates. Now, here's where it gets even more interesting. Let's say there aren't enough buyers for all the new debt the government is issuing. This is where the Federal Reserve, the US central bank, steps in. The Fed can, in a way, create new money out of thin air to buy these treasury bonds. This process is known as quantitative easing. Essentially, the Fed buys bonds from commercial banks, which injects new money into the financial system. This increases the money supply, keeps interest rates low, and makes it easier for the government to continue borrowing. It's like the government is borrowing from its own bank. This system creates a continuous cycle. The government spends, issues debt, and the Fed helps ensure that debt gets bought. Of course, this isn't a magic trick without consequences. Creating too much money can lead to inflation, which devalues the dollar and hurts everyone's purchasing power. It's a delicate balancing act that the Fed has to manage very carefully. So, the US manages its massive debt through the global dominance of the dollar, the worldwide demand for its bonds, and the powerful actions of the Federal Reserve. It's a complex and fascinating system that underpins the entire global economy. What do you think about this system? Let me know in the comments below. Thanks for watching, and don't forget to subscribe for more insights. And that leads to the first hidden mechanism that almost nobody talks about openly: inflation. Now, I know inflation usually sounds like bad news. Rising prices, expensive groceries, higher rent, and shrinking purchasing power. But from a government perspective, inflation has a very interesting side effect. When prices rise gradually over time, the value of money slowly decreases. That means the dollars borrowed years ago become easier to repay in the future. Imagine borrowing money 20 years ago when everything was much cheaper and then repaying it with dollars that are worth significantly less today. Simple terms, inflation can quietly reduce the real burden of debt. And when managed carefully, it happens so gradually that most people never connect the dots. But inflation alone is not the whole story, because if it were, the system would eventually spiral out of control. Instead, the Federal Reserve and the US Treasury constantly adjust financial conditions to maintain balance. Interest rates rise when inflation becomes too strong. Liquidity is tightened when markets overheat. Stimulus appears during recessions to keep economic growth alive. It's a continuous balancing act between growth, stability, and public confidence. And that last factor, confidence, is actually one of the most powerful forces in the entire financial system. Think about it. Money only works because people believe in it. Investors buy government bonds because they trust the system will continue functioning. Countries hold US dollars in their reserves because they believe it will remain stable. Markets remain calm because they assume policymakers will intervene if something goes wrong. In other words, the entire financial structure is built not only on economics, but also on psychology. And managing psychology is just as important as managing money itself. Now, here's something even more fascinating. The national debt number you often see reported in headlines doesn't always represent the full economic reality. That number shows the total amount borrowed, but it doesn't fully reflect how manageable that debt actually is relative to the size of the economy. Economists often look at something called the debt-to-GDP ratio instead. As long as the economy grows fast enough, the relative weight of the debt can stabilize or even decline over time. In other words, the economy can grow faster than the debt itself. But the strategy doesn't stop there. Governments also rely on complex financial instruments that most citizens never hear about. Treasury buybacks, bond maturity management, and liquidity operations allow policymakers to restructure debt over time. Old debt can be replaced with new debt under different conditions. Interest payments can shift depending on market rates, and large institutional investors, including pension funds, banks, and foreign governments, continue buying U.S. Treasury bonds because they are still considered one of the safest assets in the world. Now pause for a moment and consider this. If global investors ever completely lost confidence in the system, the consequences would be enormous. Markets would panic, interest rates would surge, and the financial system could face severe instability. That's exactly why policymakers move slowly and carefully. Every announcement, every policy decision, every interest rate change sends signals to global markets. Those signals are designed to maintain trust. But here's the biggest insight of all, and this is where the story becomes truly fascinating. The United States doesn't necessarily need to eliminate its national debt entirely. Instead, the system is designed to make the debt manageable indefinitely. As long as the economy grows, markets remain confident, and the dollar continues to dominate global trade, the system can keep functioning. In many ways, the national debt behaves less like a bill that must be paid off and more like a permanent financial structure supporting the global economy, and this is why headlines about the debt can sometimes be misleading. They focus on the size of the number rather than the mechanics of how the system actually works. Debt, growth, inflation, interest rates, and investor confidence are all interconnected pieces of a much larger financial machine. When these forces remain balanced, the system keeps moving forward. So the next time you hear someone say the United States is about to collapse because of its debt, remember that the story is far more complicated than it first appears. Global finance is not simply about numbers. It's about strategy, timing, incentives, and human behavior. And understanding those hidden mechanisms can completely change how you view the financial world. If this video made you see the global economy in a new way, make sure to like the video and subscribe to Hidden Finance Truths, because we're going to keep uncovering the financial stories that most people never hear about. And I'd love to know what you think. Do you believe the U.S. debt system is sustainable, or do you think it will eventually face a major crisis? Let me know in the comments below, and share this video with someone who enjoys learning the hidden side of money and power, because the more we understand how the system works, the better prepared we are for whatever comes next.